Companies with almost $1 million in earnings are selling for 2 times, 3 times. I put 4 of those together and I create a company that's got 4 million. I get it up to 5 million in earnings. And then I sell it for a higher multiple because it's rarer and I get like 8 times. So if I paid 3 times, that's $12 million to acquire those 4 companies. And then if I sell it for 8 times, I'm selling it for 32 million. I pay off the 12 million in debt that I borrowed to buy these 4 companies, and I put 20 million in my pocket. And we could do this in as little as 12 to 24 months.
Welcome to episode number 4. Can you make 9 figures doing this? My name is JT Foxx. This is my business partner, Adam Coffey, with 2.46 billion in exits, 58 acquisitions. Also myself, 9-figure entrepreneur. You all should pick up Adam's book. It's got 3 of them. This is one of them, and it's the greatest because it's dedicated to me and in my book, Millionaire Underdog. But he has the private equity playbook and also the exit strategy playbook as well. And here on the show, we're talking about roll-up. And Adam, can you explain very briefly what is a roll-up for people who may not know? Because I think people have skewed definitions of what a roll-up is.
Yeah, sure. No, happy to. JT, good to see you. It's been a while since we've been in the same room.
Really early in the morning, Saturday morning, very early.
It's the only time we could get together, and so it's like it's good to see you. My, just in layman's term, what is a roll-up? A roll-up is the process of combining multiple small companies in order to aggregate them, get some synergies out of them. If I've got 4 small companies, I don't need 4 accountants, or 4 accounting departments, 4, HR departments. I don't need 4 operations departments answering phones, scheduling, whatever the kind of business is. And so there's always some synergies to be harnessed, but that's really not where the magic of the upside comes from. It comes from what's called arbitrage. And so in this country, just this one, there's 34 million small companies. And because there's so many of them, there's just not enough buyers to drive up the prices. And so small companies tend to trade for really small prices. And when you aggregate them together and you get some scale behind them and built up, what happens is you become very rare. So where there's like 34 million small companies in this country, there's only 3,000 on the entire planet that have $1 billion in revenue. So as you get bigger, you get rare. And there's all these PE firms out there with trillions of dollars in capital looking for companies to buy. And so as the company is getting bigger and it's becoming rarer, the prices that people pay to acquire them, is higher. And so there's this thing that's naturally occurring called arbitrage. And so what we're doing when we're doing a buy and build, like as an example, if I buy 4 companies, and each one has $1 million in earnings, I'm going to use bookkeeping and accounting as an example because I've got 2 live examples like all set up to talk to you about this morning, and literally companies with almost $1 million in earnings that are selling for 2 times, 3 times. I put 4 of those together and I create a company that's got 4 million. I get some synergies out. I focus on organic growth. I get it up to 5 million potentially, in earnings, which is what EBITDA is. And then I sell it for a higher multiple because it's rarer, and I get like 8 times for it. Companies I'm paying 2 or 3 times for. So if I paid 3 times, that's $12 million to acquire those 4 companies, $1 million each. And then if I sell it for 8 times, I'm selling it for 32 million. I pay off the 12 million in debt that I borrowed to buy these 4 companies, and I put 20 million in my pocket, and we could do this, in as little as 12 to 24 months, 1 to 2 years. It really just comes down to, do I have my capital solved for? We can talk about that. And then can I go out and find those companies, and put them together? So that's the power of a roll-up. And that's also, JT, why we only buy good companies. I don't want to buy fixer-uppers. Arbitrage is naturally occurring. It's hard enough, to find 4 companies and 4 good people and entrepreneurs and people that think like we do, that have great cultures and they do a good job of taking care of customers. I don't need 4 donkeys. I don't need 4 pieces of crap. I want 4 good companies. Put them together, pay fair market prices for them when we acquire them small. As they get bigger, they're now rare. We trade for a higher multiple, and the arbitrage that we all share in all of these owners of these businesses can share in alongside with people like you and I. Those things, those create the arbitrage, which generates the profit. Here's the secret. This is what private equity firms do. It's the single largest driver of their returns to their limited partners is arbitrage. I built my last empire. I bought 23 companies and put them together. I got bigger, traded for a much higher multiple. I was paying on average 5 times. I sell it for 14 times. The companies that I buy that cost 230 million to buy, then sell for 644 million, pay off the bank debt, put 414 million in your pocket. I mean, this is how institutional shareholders on a large scale generate the returns for their investors that keeps private equity growing at this outsized pace. It's all about arbitrage. Roll-up is putting small companies together to create a bigger company. Anybody can do it. It's just the primary way private equity does it. And so what you and I are doing is we're teaching the regular people in the world how to do this kind of stuff too.
We teach them so that we can do them with you. And I think that the mistake that people come to us is you'll come to us and say, hey, I want to do a roll up. And you come in and first of all, your business has to be fixed. That happens everything. A lot of times it's not equipped to do to acquire another company. You don't have the systems in place. So people say, okay, I want you to come in. I want you to fix it. I want you to grow it. I want you to help me manage it. I want you to find prospects. I want you to help negotiating. I want you to help the capital. And I want to do a huge exit. And like, you do all the work and I just want to get there because I have a company. And
you want me to wipe your ass when you go to the bathroom too? It's like,
Right. I mean, that's the whole point. At least sometimes you have to go under the hood. And by the way, if you want to do this with us or learn from us, adamcoffey.com, or the link is in the comment. Please give us your thoughts on this. So the reason why, like right now, most companies trade on average between 1 to 3, right? So 1 to 3 times, right? So you have a company that's like 200,000, you're going to get between 200,000 and maybe 600,000, depending on the industry. The multiples, we got to get to 4 million in profits, EBITDA. And we got to get to 10. 4 million in EBITDA gets you an exit of over $30 million. A 10 million gets you 105 and above, right? And that's the magic. Now, if you're making 1.5 million in EBITDA and you got to get to 4, the mistake that people make is at the end of the day, you have to spend a lot more money in marketing. You have to spend a lot more money on infrastructure. And at some point, I find businesses, when they get to 1.5, 1.2, they kind of stuck, right? They got stuck. They also got comfortable, right? The same drive that got them to make $1.5 million a year in EBITDA is not driving them to the 4. So the only way you can grow quickly, right, with the systems is in essence acquiring or merging with another company under yours so that you can have scale, get new customer bases, and get you to the 4 to 10. That's why it's important. Comments, and then we're going to go in. Can you make 9 figures doing this? Go different industries. What do you think about what I just said?
First thing I want to tell you too, JT, is that not all companies, not all industries are created equal. Most companies trade as a multiple of EBITDA, but EBITDA is this arbitrary place on an income statement that if you look at your QuickBooks reports, you're not even going to find it because it doesn't exist. We have to calculate it. But at the end of the day, there are certain types of companies and industries that are better suited to this exercise. You and I were talking about a guy that we both know that we're working with, who has a construction company. And a construction company, he has good EBITDA, but he also has to buy a lot of very expensive equipment. And that expensive equipment lowers his free cash flow. And the magic of the common person or the small guy doing this kind of activity is the fact that we want to use the cash flow within the business, embedded in the business, to pay for and service the debt that we require to buy the business while we're doing the roll up. And so certain industries, and I'll just say in general, services, period. If I think of professional services, it's like bookkeeping, accounting, payroll, it's wealth management, it's anything where the IP is your brain, and so I brought 2 bookkeeping examples that we can go through, at some point. These were real deals I've analyzed in the last 24 hours, and I wrote it all down. I'm like, I know I'm with JT tomorrow. It's like, I got to talk about these because the examples are just stunning, what a person can actually do, a little guy can do with companies like this. And so not all companies are created equal. So if we can find companies that are based on needs, not wants, contracted revenue, not project-based revenue, because needs and contracted revenue, those types of revenue streams are very stable in a volatile economy. Companies that are focused on wants have this cyclicality. When the economy goes south, their revenue disappears. We see that a lot in construction type companies, and so there's not all industries are created equal, but when we hone in on the right kind of industry, then we've stacked the odds in our favor that make things, much more attractive, and raised the odds and made it a higher probability that we're going to find success.
Let me ask you a question. What's better? So let's say the company that we're part of and we're involved, we do many, but this particular one, before they met us at the end of the year, if he's showing a profit of $1.5 million, they usually take that $1.5 million and to lower their CapEx, their tax bases, they'll just buy a piece of equipment. They'll just buy something. Yeah. And the idea is to, pay the least amount of taxes possible, maybe possibly because they're going to need the equipment down the road, or they do need the equipment. In your opinion, is that a good strategy, a big mistake to make? Because then when they want to like sell and roll up, it's like, hey, you're not making that much money, but they're like, well, I'm just paying down my taxes. Just like the idea of a cash business, right? Well, people like, well, I take cash, I don't declare the cash. But yeah, when you want to sell your business, you telling me you have cash, unfortunately, I can only go by what you put in there based on the current valuation, not the side deals. Is that a right strategy in your opinion? Does it help or does it hurt?
Well, so it's a double-edged sword, right? So that construction company, when it's analyzed, by someone like Dennis, our partner, he when we ultimately wind up valuing the company based on its assets rather than its earnings. And so an entrepreneur is programmed, I don't want to pay taxes. Therefore, if I've got any income, I want to use it. I want to prepay expenses. I'm going to buy stuff that ultimately I'm going to need, and I'm going to get my taxable income as low as is humanly possible. And so there's a double-edged sword there. The good part is you're not paying taxes while you own the business. Problem is when a guy like me comes to look at it and wants to buy it, or a PE firm wants to buy it, we look at it and say, damn thing doesn't make any money. If it doesn't make any money, it's not going to be worth anything when we sell it. So I would say I'm not telling people to stop trying to avoid paying taxes. I'm trying to say that if an exit is on our horizon, we have to be very careful in thinking about how we want to operate our business, run our business, and be thoughtful around that, because ultimately we're going to be sold as a multiple of those earnings. And if I'm down to just simple assets, that's a bad place to be, because assets depreciate. I buy a dump truck and I drive it off the lot and it's now worth, 60% of what the hell I paid for it, just like any other car. And so asset valuations of a bunch of construction equipment is going to lower the value. And guess what? Construction companies tend to trade for lower multiples. So not all industries are created equal. We do have to be very thoughtful. If we're eventually going to be a seller, we want to operate our business to maximize its profit potential. We still want to minimize taxes, but I want to get very sophisticated in how I keep my books, because what I ultimately pay taxes on is different from what I want to add back to my earnings. And I have to be aware of what is a legitimate add back to earnings, so that when I'm presenting my numbers to a seller, I'm using adjusted books and I'm explaining the adjustments that we made. Hey, my wife has been making $100,000 a year. She only shows up once a week. She sure as hell doesn't service any revenue. That's an add back to my earnings. So here was my as reported earnings. Here are the add backs that I did for lifestyle purposes. Here's the airplane. Here's my lake house. Here's Uncle Jimmy, who's dead, but he's still on payroll. It's like all the crap I do. It's like I want to be very thoughtful and methodical about setting up my books to be able to present myself in the best light. And I got to tell you, recently I've been looking at a lot of books for entrepreneurs, working with some of the people that we're connected with in the chairman group. And, ultimately, most entrepreneurs actually underreport profits, because they're putting expenses that should be capitalized and they're putting them into their operating P&L, and it's artificially lowering their earnings. And so when they're presenting their books to a buyer's looking at it, and it's like their books are screwed up. and it works to the buyer's favor because they have artificially low earnings. And so we have to be really sophisticated when it comes to operating our business and get the help that we need around the table to make sure that we're doing things in the best fashion to present ourselves in the best picture to buyers.
Let's take it to the next level. Can you make nine figures doing this? We talked about landscaping in the show, and we're going to go as many different industries throughout all the episodes. And I strongly recommend you go back, listen to the first three. They were absolutely phenomenal. Talk about many industries, and even if it's not your industry, learning the fundamentals and also learning what others are doing. So now let's talk about the accounting and bookkeeping. So I do a lot of business all over the world, specifically Australia right now, even though I'm very embedded here in America. Tons of accounting firm, very profitable, prime for a roll up. Now in America, we're starting to see a lot of different things all over the world. Accounting is not a sexy job by any means. People have a hard time finding accountants. They're outsourcing a lot of it to India, believe it or not, the basic grunt work, and other countries, because they cannot find people here. And as soon as you find a good accountant, the big four come in and trying to steal them away for you and overpay, which I've seen that happen a lot. What are your thoughts about the accounting and bookkeeping as a roll-up?
So I'm currently working with multiple large, sophisticated, roll-up, organizations. So call it PE firms or family offices that are doing it in this space. Also working with some smaller entrepreneurs, members of the Chairman Group, who are doing this, in this space. And so in the last 24 hours, I was on multiple calls with multiple buying groups that are starting to focus on this space. And these are real deals. And I rounded all the numbers just to make all the math easy for people that are listening.
Full disclosure, before some of you watch this and start criticizing and doing sub videos about that, it's amazing how many people criticize have never done a roll up in their lives. And you've had 2.46 billion, a $3 billion one coming in 2025. So it's just amazing to see.
Well, hey, look, JT, I'm genuinely trying to help people learn how to do this, and
hopefully so we could do it with them too. Let's be very clear with that too.
Yeah, so we have multiple ways of helping people get to the right size to start doing this, and then actually helping them get these first roll-ups done, get them under their belt. But here's a couple examples of a real deal that I looked at yesterday. So I rounded everything to the closest numbers to make it easy. So one that I looked at had $3 million in revenue. It had $1 million in EBITDA. And that's what I'm finding with these professional services businesses. They're around 30 to 40% profit margin, and that EBITDA, because I'm not buying dump trucks and cranes and a bunch of stuff. I don't have a plant. It's like you got very few assets. You got some computers sitting on desks. You're using brain power, and so the business has very high free cash flow. So 3 million in revenue, round numbers, $1 million in EBITDA, about 900,000 in free cash flow. The purchase price being asked by the seller 3 times. So it's a $3 million enterprise value. Now, if we do a $600,000 rollover, so round numbers 20%, but if I'm doing SBA financing, it has to be 19% or less, but I'll use 20% for easy math. So 3 million purchase price. I'm passive. The person that's buying this company is passive. We need the entrepreneur to stay. They're going to participate in the roll-up, and they're going to make a crap load of money alongside us because we need somebody to run the business. So 3 million EV, they roll over 600,000 of their equity into our new holding company that we're going to aggregate all these businesses. So I need $2.4 million to purchase the business. Now, my buyer is putting in a couple $100,000 as a cash down payment. Didn't have to, but the banks love to see some kind of money. Can you put 50? Can you put 100? This person's putting $200,000 down into this. So I'm going to have a $2.2 million loan. And if I use 10% interest just as a round number, then to service this note at 10%, fully amortized over 10 years, which would be a typical SBA, 7 series loan, I'm looking at about $330,000 needed per year to service this note to own this business. I've got 900,000 in free cash flow. Almost, not quite, but almost a 3-to-1 debt coverage ratio. This is not only a slam dunk buy, but the person that's buying this is not only going to be able to use other people's money to buy it, but they're also going to have 600,000 per year in excess free cash flow. And so if they now own 81%, or let's call it 80%, and the current owner owns 20%, we're going to keep some of that money in the business for expansion and advertising and growth. But they may be distributing $300,000. This entrepreneur may get that 200 grand that they're putting into it as a part of the down payment just to make the financing easy. They may get that back in the first 12 months. And so this is a great example. I owned an insurance agency for 15 years with my brother, and it was just a cash cow. It was like our ATM machine. We just distributed money every year, and then we sold it, and we sold it for 3 times higher than the purchase price that we bought. And between all the distributions that we made during the time period we owned it, and then the final sale, it was like not the biggest dollar, but the biggest return, in multiple of my invested capital over time was that deal. Another one I did, even better, a little bit smaller though, $1 million in revenue, round numbers. It was like 991, 500,000 in EBITDA, and around 400,000 in free cash flow. So this particular deal, again, this is a person who's passive. We need the person that's running this business to stay and be a part of our enterprise. They're going to run it for us, and so $1 million enterprise value. And so it was $1 million revenue, 500,000 EBITDA, selling for 2 times. This was not the price that we offered. This is the price that was asked for, 2 times. So it's 2 times $500 million purchase price. This entrepreneur is putting down a couple hundred grand as well. We're looking at about $800,000 needed to close the deal. I'm sorry, 200,000 roll, 800,000 purchase price. This person's only putting down 50,000, and so I need a $750,000 loan, fully amortized, 10 years, 10% interest, SBA 7 series. I'm looking at about $110,000 a year in payments to service this note. We have 400,000 in free cash flow. Debt coverage is like 3.8, and so in this particular case, not only is it a slam dunk for financing, but here again, the entrepreneur is probably going to be pulling out $100,000, $200,000 a year comfortably from buying this. These both were real deals that I looked at in the last 24 hours. And so, it's like there's good deals everywhere, different industries. We don't want to overpay. We want to buy good companies performing well from people who have a realistic expectation on value. And, those were 2 examples from bookkeeping. And I'm seeing a lot of activity in bookkeeping right now. Still see a lot of activity in pest control, and a lot of these different sectors that you and I have talked about in these other episodes. But, right now I find myself, turning over a lot of bookkeeping rocks and looking at bookkeeping companies, not all created equal. People don't want bookkeeping companies that do audit work because those are required to be owned by a CPA. And so it's like I'm looking for people that are doing bookkeeping. They have recurrent revenue contracts. Their customer is small business, people on QuickBooks who need their books, need help getting their books in order. They do tax work for the business owners. They may do some payroll work, and so it's like that's kind of the profile of the perfect little bookkeeping company. And I'm seeing roll-ups all over the place. You and I right now in the chairman group, we have 3 members of the chairman group who are actively doing roll-ups in bookkeeping.
And is it because it's easier to go after that, because the accountant, after he exits, doesn't really know what they're going to do. They want to retire, but they don't really know what to do, as opposed to the bookkeeping could be like, I can always go work for somebody else and make 100,000, 125,000, and not deal with the pressures of all the business, because it's demanding work. And also every accounting firm has to be getting and is getting offers to acquire, whether people are serious or not, right? This is kind of like a marketing mill for these people. So there's less crowded waters in bookkeeping, although accounting is still very good. Would you agree with that assessment?
Yeah, what I'm going to tell you is it all really revolves around fragmentation. And so I just brought up one of my little tools real quick, and so I'm on Dun & Bradstreet Hoovers, and I'm just going to type in bookkeeping real quick. Let me pull this up, and so I was going to tell you how many there are in the United States alone. and it's an impressive number. So
This is
counting.
live. This is live deal making.
Yeah, this is live stuff. Accounting, tax prep, bookkeeping, payroll services. In the United States, JT, I shit you not, 1,818,847. There are just not enough buyers on the planet. Even though these are great companies with lots of really nice, I'll call it financial statistics, very high profit margins because we use our head to generate revenue. We don't have to manufacture anything. There's just not enough buyers out there. And so just so people know that I'm not bullshitting, I'm going to pull up my little screen and I'm going to share it. Right now, we're looking at Dun & Bradstreet Hoovers. It's a tool I use every day. I've got in NACIS code 5412, accounting, tax prep, bookkeeping, payroll services, right up here at the top. 1,818,000. You want to see where they're at? Here's the list of all of them, and it includes all the big boys too, but it includes all of the smaller ones that we're going to find in that population. 1.8 million. There's only about 8,000 private equity firms. They aren't all doing bookkeeping roll-ups. They sure as hell aren't doing them all small because there's a small number of firms that focus on smaller companies, and there's a lot of bigger firms that focus on those bigger companies. What we do when we're fishing in this sea that's got 1.8 million fish, we're looking for 4 or 5 to put together, and then serve them up. I talk about my last roll-up, which was in HVAC, and there were like 50, 60,000 commercial HVAC companies in the US that we had identified. I bought 23 over a 5-year period, and then exited. It's like, there's still a crap load left. It's like I could be doing this roll-up strategy in that industry for the next 100 years, and there will still be, you and I have talked about landscape maintenance before, and that hits a lot of my boxes too. There's been multiple multi-billion-dollar roll-ups done in that industry, and there's still heavy fragmentation. There's like, just like we saw 1.8 million bookkeeping firms, there's like over 1 million landscape maintenance companies in the United States. And so as a result of that, it's like what we have to do. But I have a client who owns a chain of quick serve oil change places. So think like Jiffy Lube and Valvoline. And it's a private label, privately owned by 2 brothers. We were doing the same exercise. And when I'm on Dun & Bradstreet Hoovers, there's only 12,000 in the entire country. And so if you're doing a roll-up, we need a big seed to fish in. We need a lot of companies because that means there's not enough buyers to drive up the prices. And so we can hunt, we can find good little ones, pay fair market value, which is cheap, put them together, make it bigger, and serve it up as a meal to a middle market, lower middle market private equity firm who comes in and says, cool, because they don't have the time or the ability to do a roll-up of these small companies. They need someone to kind of serve them up a meal, and they're looking for companies to rise out of that 1.8 million, to get just to the right kind of size, like around 4 million in EBITDA. It's like, okay, now I got buyers swooping in to come take them, but they can't go down and buy these little companies like I'm talking about. They're just not geared for that kind of time frame, in that size transaction. So, real life. Bookkeeping, accounting,
listen,
US, 1.8 million.
If you're interested in doing this together, you can go into the chat, or go to adamcoffey.com. We'll see. We can have a meeting as well, whether to take a look under the hood or just do business. All kinds of industries all over the world as well. Adam's also working in Australia with some of the biggest family offices. And the point of this podcast is to either educate you, so you can do it yourself, or we can do it together. Either way, this is real type. There's so many people out there teaching this stuff and have no idea what they're doing. And they're good at marketing. But remember, the man's wrote 3 best-selling books about it and has done it. And it's got a $3 billion exit coming on top of having 2.46 billion 58 acquisition, and a lot more coming, a lot more deal activities and that. And on the next show, we are going to talk about something that is how the PE world works. Why do they come in? Why do they pay more? What are they looking at? So now you're going to get, what are they looking at? Too many of you are in love with your company. So we're going to deal that on the next show, but make sure you subscribe, you like, you comment, you check out the website. It takes 2 seconds. means the world to us as well. If you could share it to somebody else that may be interested in doing business with us, we're open. I am JT Foxx. This is Adam Coffey, and we'll see you on the next show.